This video will take you through the purpose of accounting, including the role played by the accounting equation, which is the basis of accounting, and how this relates to the statement of financial position. To start with, I want you just to try and put yourself in the position of someone who has decided to earn some extra pocket money by making muffins to sell to your friends and neighbors. Imagine that you have borrowed 500 Rand from your mother to buy the necessary ingredients. After the first 2 weeks, imagine that you've sold lots of muffins and you are very excited. Now, of course, you think you're rich and you've done excellently well. However, your sister points out to you that you only have 400 Rand cash, and yet you started with 500 Rand from your mother. I want you to think about a few things now. Firstly, how can you decide whether or not your business venture has actually been worthwhile? Well, if you look at it just on the face of it, you have a problem because you've got less money than you started with. But this is not necessarily the only thing that you need to look at. So I want you to consider, does cash necessarily indicate the actual profit? What else might you need to factor into your calculations? In addition to your wanting to know how well or badly you've done, who else might want to know how well or how badly your business is doing? Well, let's look at both of these last two questions. It's quite possible that you maybe sold your muffins for less than all the ingredients cost you, in which case you've made a loss of 100 Rand. However, what if instead of selling for cash, you actually sold a lot of muffins on credit and 600 Rand was owed to you? In that case, you actually would have had a total income of 1,000. If you subtract your expenses of 500, you would then have made a profit of 500 Rand. Who else would want to know? Well, if your mother lent the money to you, it would certainly make sense that she would be interested in seeing how you are doing. What accounting does is accounting actually helps you to identify how well or how badly you've done. Keep in mind that all businesses usually exist to make a profit. If not, they would generally fall under the category of some form of non-profit organization or a charity. But we're going to work on the assumption that you are looking at businesses which are out there to try and make some money for the owner. Obviously, social responsibility is also very, very important, and you want to make sure that you are not harming the environment around you. You are trying to do things that are good for the community in which you operate, etc., but you still need to make a profit. Therefore, you want to try and keep track of how your business is doing in order to ensure that your business remains profitable and, as a result, sustainable. In other words, you want to make sure that your business is doing well enough that it will be able to continue operating for the foreseeable future. Obviously, cash flow is also important. It's all very well selling your muffins on credit, but if nobody pays you back, you are going to lose out. So it is important to make sure that in addition to your credit trading, you do have enough cash moving in and out of your business at any time. Bookkeeping is the activity that will track your financial activities. In other words, where you're going to record all the data of what you bought, who you sold to, where the money came from, etc. Generally, you would use source documents, etc. to help you track all of this. Accounting, however, takes it a little step further and presents this information in a manner that is easy to understand for everybody who might be interested in the success or failure of the business. All of these people who have some interest in the business for whatever reason are known as stakeholders because they have a stake in the business. Obviously, the owner has an interest because they've invested their money and want to make a profit. A bank who's loaned money to the business would be interested to see if the money could be repaid. Any tax authority would be interested to see how much tax you owe and whether you are actually reporting your tax correctly or not. In South Africa, this would be the South African Revenue Services. Your employees might want to know how well your business is doing, to see if they are secure in the job, to see if they are being paid a fair salary, etc. Suppliers would be interested in the success of your business because they want to know whether the accounts would actually be paid if they have sold to you on credit and you owe them money. And lastly, customers, particularly where you are selling goods that require a lot of after-sales service, for example, a motor vehicle. If you sell your vehicles to customers, but you're about to go out of business next week, they are going to be unlikely to want to buy that car if they don't know if you'll be able to maintain your after-sales service if something goes wrong. What I want you to do now is to find a game of Monopoly, which you should all be familiar with. I want you to try and get some friends or family to join you and actually go and play the game. You could check the shortened rules to try and speed it up if you don't have a lot of time. Basically things like allowing yourself to buy on the first round rather than waiting until you've gone around once, maybe starting with less money, etc. Play the game. Obviously the aim is to try and control the board, in other words to own lots of property and as a result be able to earn lots of income. Once you've finished playing the game, I want you to list all your assets, in other words, the things that belong to you or that you have got control over and that are generating an income. In other words, this would be your properties, your streets, any houses or hotels that you've put on there, your water and electricity board or services, etc. In a separate space, I want you to also list all the liabilities. In other words, the money that you owe to somebody else. Maybe you own a street, but you were short of cash and you therefore had to mortgage it. How much do you have to pay back to the bank? That is your liability. Maybe one of your friends or family helped you out at some stage and you've promised to pay them back. Those would also be liabilities. What you can do then is, once you've listed all the assets and all the liabilities at this point in time, you can calculate your equity. In other words, how much are you actually worth at this point in time? What you'll do is, to calculate your equity, is you would look at all that you own, your assets, but hopefully you can understand that you would also need to subtract the liabilities or the money that you owe from that, and that will tell you your net worth or what you are actually worth. You are then able to calculate your profit or loss by simply looking at, what did you start with? What was the money that the bank gave you right at the beginning of the game, or this is also known as your starting capital. And if you compare that, it's usually 1,500 if you're playing the standard game, but you might have done something different. Compare it to your equity now. If your equity now is 2,000, that means that you've actually made a profit of 500. In other words, the difference between your current net worth and what you started with. If, however, you have now got much less than what you started with, maybe you only have 300, well, the difference between the 300 you have now and the 1,500 you started with means that you've made a loss of 1,200. If you wanted to, you could also have tracked all your incomes and expenses throughout the game and listed them. In other words, the rentals that you earned from other people landing on your squares would have been your income, and the expenses would have been any expenses you incurred, paying birthday presents to others, rent to others, etc. And if you work out the difference, it should equal the profit or loss that you have just calculated by comparing your equity to your starting capital. So that actually answers the question of what incomes and expenses would have contributed to this profit or loss. Think about all of them and list all of them. There were your rent incomes, your rent expenses. What about the 200 Rand you earned every time you passed Begin? What about maybe the money that you had to pay to get out of jail? All of those would have contributed to your incomes and expenses. However, the money that you spent on your assets or received from liabilities are not part of your incomes and expenses. They are your assets and liabilities, so you would leave them out. So, what is accounting? Accounting is there to keep track of your money and your profits and then report on it nicely to people who are interested in how well your business is doing. We are going to look at where we obtained the money from, either from the own contribution, in other words, in the Monopoly game, the 1,500 Rand that you may have started with, as well as any money that you borrowed from either your friends or by mortgaging a property with the bank. That would be your liabilities. This equity and liabilities would both be used to buy the assets, or in the Monopoly game, the streets, the houses, and the hotels. You are then able to generate an income as a result of having all of these assets. That is the whole purpose of running the business, is it not? So the accounting equation you have actually identified without realizing it. You start off with your assets, which is something that the business uses to generate your income, all your streets, your houses, your hotels. And if you look at the value that you calculated over there, you can compare this to all the money that you put into the business, your owner's equity or your net worth, plus all the money that you borrowed from the bank or from your friends. And that is how you get this lovely equation, assets equals equity and liabilities. It's actually really logical. Quite simply, the money to have what you've got now must have come from somewhere. You were financed either by the owner themselves or by borrowing money from elsewhere. So, I want you now to take out a packet of Smarties. Hopefully you've been shopping and have kept some nice sweets in your cupboard generally. Don't laugh, we are going to need to use sweets regularly in this accounting program. It just helps you to understand better what's going on if you can actually move things around the board. So what I would suggest is if you've got Smarties or any other little sweets, go and get them now. If you don't, try and maybe use some beans or anything you like, but Smarties are much more fun because you can eat them afterwards. And now what we're going to do is we're going to consider a couple of different situations and see how this affects the accounting equation. On the one side, I have indicated what my assets would be, in other words, what I have that is going to earn me my income. And on the other side, I'm showing where the money came from to finance those assets, either from the owner, my equity, or that's borrowed, my liabilities. Your assets would include things like your vehicles, your equipment, your bank. All of these are things that belong to you. So your vehicle, your delivery van, for example, you will use to generate an income by delivering your goods to your customers or offering a courier service, perhaps. Similarly, your equipment and your bank account are also going to be very important in order to generate your income and run your business. Your equity is going to have capital, which is the money that you invest at the beginning. So what you started the game with, your 1,500 Rand, as well as any current income. In the Monopoly game, the rental income that you earned or any other means of earning money along the way. Note, however, that your equity might be increased by capital and current income, but will also be decreased if you have to spend a lot of money on things like expenses. In a business, perhaps advertising, vehicle expenses, etc. So whatever service you are offering, you need to let people know about it. And you're not going to earn money directly back immediately. It will generate money in the longer term, but right now you're just going to have to outlay that money and then hope for the best. So those expenses over here are going to have to decrease your equity because they will contribute to making a loss, or hopefully your current income will be bigger than your expenses and then you can have a profit. Your liabilities would be made up of a loan. For example, any money that is borrowed by the business, which you would have to repay at a later date. Let's now imagine that the first transaction is that the owner contributes 5 Smarties to start the business. What 2 things are going to be affected? Well, if we are going to have the owner contributing money to the business, obviously capital is being invested, so the equity is going to get bigger. But at the same time, my bank account will get bigger because there's money that has been invested in the business. Okay, for each transaction, we're going to decide which 2 accounts are affected, as I've just done. I've said capital and bank. We are then going to look at our equation and decide if it's assets, equity, or liabilities, and whether our assets, equity, or liabilities will increase or decrease, and we are going to adjust the Smarties accordingly, and then check if the equation actually balances. So let's look at that again. Capital and bank are affected. We will want to put 5 Smarties in my assets and 5 Smarties in my equity. You can see now that it does balance because there's 5 on the asset side and there's 5 on the equity and liability side, so it works. Let's have a look at the next transaction. Bought a laptop to do business administration for 2 Smarties. In this case, you actually are only going to have 2 assets affected, namely equipment and bank, because what's going to happen is that you are going to take some of your money from bank and you are going to remove it because you no longer have that. However, you now have them in equipment, and so you're going. For the third transaction, you took out a loan of 3 Smarties and used them to buy a delivery van for the business. In the same way as you moved money from the bank to the equipment account, you're going to do exactly the same thing by moving money from the bank account to the assets, except you didn't actually have the cash. You took out a loan. So therefore, you would need to show that you are taking out a loan in liabilities and then show this in your assets for vehicles. If you wanted to, you could have put those extra 3 Smarties in bank first and then take them out of bank and put them in vehicles. But going directly between loan and vehicles is certainly a faster way of doing it. Number 4, paid 1 Smartie for petrol. In this case, bank is going to be affected, but so will vehicle expenses. Petrol is something that gets used up. So it is going to be an expense that will decrease your equity or contribute to making a loss or reduce the profits. So we'll take 1 Smartie from both bank and from equity because my equity is now decreasing. Number 5, paid 2 Smarties to advertise the courier service. This is going to work in exactly the same way as the previous transaction. The only difference is that my expense is a different expense, advertising. So I'm going to take 2 out of bank and another 2 out of equity. If we want, we can do a quick check and my accounting equation does still balance. In total, I have got 5 in assets and 5 in equity and liabilities. Number 6, earned 4 Smarties for courier services provided to clients. In this case, your bank is going to get bigger and your equity is going to increase as a result of your current income. So you will add 4 Smarties to both assets and to equity. And lastly, paid 2 Smarties in part repayment of the loan. In this case, what happens is your bank and your loan are being affected, and both the assets and the liabilities have to decrease. Notice that while you were doing this activity, if this was your middle line, everything you did was always the same on both sides. So either you added to assets and equity or liabilities, or you subtracted from assets and equity and liabilities, or you simply moved it around in assets, or you could also move it around in equity and liabilities. What you can't do is add to one side and subtract from the other. So your basic assets, equity and liabilities look like this. What you've got is your assets, which could be your property, your vehicles, etc. And those are going to be divided into both non-current and current. We'll look at that in more detail at a later stage, but quite simply, this just means my assets that I'm going to keep for the long term, compared to the assets that I'm only going to have in the short term, and they will probably turn into cash within the current operating cycle or the current financial year. My liabilities, when we were looking at a loan, we just had our non-current, but in actual fact, you would also be able to have current liabilities if, for example, it was your suppliers that you owe money back to in the short term. So your non-current assets were our land and buildings, vehicles, equipment, investments. Current assets would have been bank and cash float. Your equity is going to increase with capital. And if you take money out of the business, it would decrease with drawings. Similarly, it would also increase with incomes and decrease with expenses. But we'll worry about that in more detail later. The liabilities, the loan is a non-current loan. If you had a short-term loan, that would be classified as current. Now, all of these things can actually be illustrated in a way that is simpler for non-accountants to actually understand. And this we do in the form of something called a statement of financial position, which is simply a statement, a piece of paper explaining what our financial position is. In other words, what do we have, what do we owe, what are we worth? So you can see here it's got all the assets, non-current and current, that we've already discussed, and you simply add them all together, and that will give you your total assets, which should equal your total equity and liabilities. So hopefully you can see assets go at the top, equity and liabilities go at the bottom, and that is all that you need to understand a statement of financial position. You might sometimes still see it referred to as a balance sheet. That's the old terminology that was used a very long time ago, but some people do still refer to it. And if you see both